everyone. I'm Rick Bensignor. Today is Tuesday, December 1st, and welcome to this week's In the Know Trader Show. Well, we've got a lot on tap for this week. The agenda is going to start off with revisiting a topic we've talked about a couple of times recently, but I want to continue to, and it's about exiting at target prices that you've set for yourself. So we'll talk about that a bit some more. In our market overview, we'll take a look at the Dow Industrials this week, the US dollar index, and crude oil. And I purposely picked crude oil this week because of the significant bounce we saw in the energy sector in the month of November. It was XLE was up about 30%, give or take. So it had a monster month. And oil's been up too, but I want to take a look at oil and see if we can expect a heck of a lot more out of energy or not. And then this week we'll actually focus on the financial stocks and the sector, because it also had a very good November after being in the doldrums. And I took a look back at my notes, and it's been since late June since we've gone kind of stock by stock through that sector. So we'll take a look at as many of these names that we can get through. We'll start with XLF and then get down to individual names. And these are ranked in market cap as far as how big they each represent the percent of the XLF. So that's what we've got on tap for this week. I want to, I always show you the slide each week, and I want to talk to you especially about one thing here, which is the 7-Eleven monthly spider sector report, which came out to subscribers last night. It was November 30th. It's the end of the month. So I did a scrambling of, as I do every time that report comes out, there's a heck of a lot of last minute work that I can't do until after the close on the last trading day of the month, because I need all the final tallies. But last month, here's the advantage for those of you who are longer term investors looking to do better than the market itself, right? If you buy the spiders, you're going to get the market's return. We're looking to outperform the S&P, like essentially every portfolio manager is who uses the S&P as a benchmark. So I believe that we can outperform using the models that we do instead of just getting the simple return of the SPY at the end of the year. Whether it's up or down, I think I can do better. So this past month, we outperformed by another 82 basis points. So, 0.82% since we started this on August 1st. So we've done this for 4 months now, where you have outperformed just beneath 2%. So if you annualize that, we're somewhere in between about 5.5 to 5.75% better than the S&P. If we are able to keep those numbers going so that the annualized rate is accurate, that would actually put you into home run territory on Wall Street. If you are a mutual fund portfolio manager and you were able to beat your benchmark by over 500 basis points, essentially, over 5%, you would be one of the kings or queens of Wall Street. So we are currently on pace to do that, and that's why I created the 7-Eleven monthly report. It's very reasonably priced for a 36 or 7-page report that comes out every month. And I don't urge you, but if you are a person who wants to beat the market over time and you're willing to do a little active management, and you'll learn yourself about what it means to actively manage your portfolio. And all it takes is a little tweaking each month, because we're not going to use more than 7 of the 11 macro spider ETFs to be in at any one time. And currently, like for the month of December, we've only chosen 6 of them to be in as outperformers or neutral. And so even with a month like last month, where energy was up 30% on the month, and financials, I think, were up 15%, outperforming the S&P's. I think it was up 10.88% last month, one of the best months ever. We had no exposure in financials. We had no exposure in energy, and we still outperformed the S&P because of how we allocated the 6 or 7 funds that we were in. So for anyone who likes the idea of beating the market's returns with not a heck of a lot of work to do it, I suggest you subscribe to the 7-Eleven report. I also have the weekly ETF Tactical Trader report, comes out Wednesday nights, reviews key markets, including always an in-depth view of the S&P and what I'm thinking there, as well as some other cross-asset markets like bonds and the dollar and gold and anything that kind of affects the big picture. And then we put out a new ETF idea each week, and that's what you get in the weekly report. If you want to reach me, it's rick@inthenotrader.com. Okay, so let's go back to, again, revisiting exits that you set up at targets. And what I wanted to do is just go to a couple of names that I myself have had on in the last month or two. And let's see if I can, did I leave it here or do I have to put, here, we'll take this away. Let's put something like, so here's a name. We've talked about this before. I got into Chevron at $75, leaning on this TDSD line. This is a weekly chart. And even though it broke through, hold on, I'm just trying to erase this line. There we go. Even though it broke through the level I was hoping would hold, I was still confident that we weren't going to break the lows of the year, and energy names obviously had been beaten up, but a name like Chevron I thought would be a better name than Exxon. And so I paid 75. I had to watch it intra-week, trade 65, but then energy took off in November. And the target I had all along to get out of some was 91 and change, which from my 75 was $16, a little more than 20% above where I had gotten in. And when I took it off, it went above where I got in. And instead of going, darn, why did I get out? I looked at it as great. I still have half on. And if I'm right, over time, this could get up to the 117 to 121 and a half kind of area up in here where I have other upside targets. If I switch this to a daily chart and I see where I got out, I guess it was this day here because I had a resting order. So I got out just about 91, and the next day gaps higher and closed on the high. A lot of people were going, darn, I should never have done that. And yet this is the price action since. So we've now spent, a couple days back beneath. And clearly, I don't want to see this sell off. I'm not trying to make myself be right by saying, see, I sold it at 90 or 91. It's just, it was the target that I initially set to sell half of what I had on. And so I stick with those ideas of when they get there, I'm always going to sell at least half of what I have on. Now, do I want to see this come all the way back down and fill the gap? Definitely not. I want this to go up, and I can play a breakout through the same kind of 90.77 level, which is the TDST line on the daily chart. This was not a proper breakout. If you are a subscriber, you know that this was not a qualified and confirmed breakout. So even though price went above this, I don't have, it didn't do it in the way I wanted to see a real breakout happen. If it now breaks out above, I can always put that half on that I had sold out and play for this to play out a 13 on the upside or hit, daily targets or whatever. But it's an example of why it's important to take profits at the targets you set. Because if I had done nothing on this day and said, see, it's a good thing I didn't sell, I don't think I would have sold out that day either. This day, maybe I'd say, oh, doji, it could turn around. Then you open lower the next day, you close on the low. Now, all of a sudden, you're 2 points lower than where you wanted to sell. And now you're kicking yourself. So I stick with the idea of when you hit your target, you take at least half off. That's just one thing. Here's a name that we got into before the November elections, a few weeks before. This was a pot stock. It's not even a stock. It's the ETF for the marijuana um, group. So MJ is the ticker. And I don't remember exactly where we got in, but I'm thinking probably somewhere right near here, because it was probably leaning on this propulsion exhaustion level. And I already fundamentally believed that the cannabis names had already been so beaten down, and that there were a number of referendums on upcoming elections. 4 different states, had referendum to legalize weed, and they all passed. So I had a feeling, regardless if the Democrats were going to win or not, Democrats winning probably would give it more boost. But what we did is we took half off at 13.38, give or take. That was our target. And again, it went above there the next day, it pulled back, and now it's moving higher, and that's great. So I've sold half with at least a 20% profit, and now I can play, further what I want to do. And I can use a sell stop down here if it breaks, let's say 1490 correctly or whatever. It gives me a lot of flexibility to have taken half and to play with the other half. Because 20%, I'll take 20% on a trade. On half to play with the other. I'm not going to let it turn into a loser, so I'm certainly not going to let it go lower than, let's say for sure, 12.95. I would stop myself out before that would happen. But it gives me flexibility. And here, if I look at a weekly chart, this is part of the reason. Double bottom, 13s and 9s on both bottoms back in March and here in September, October, and that's what we bought. So we got in long right near $10. And I can play for 19.45. Which is the propulsion target up on the weekly chart. And that'd be a home run. That's almost 100% gain on that second half. Lots of flexibility, but I know I've locked in profits. So that's one for you. Here's one that we also have had in the Tactical Trader Report, and we've been long since $30 in March. So we bought the sell-off here. We had to watch, another week of bad pricing, and then it started coming our way. And we sold about a third in the upper 40s. We sold another third off of the monthly chart in the low 50s. And just last week, I got it out of the rest. And I've had this name on myself too. And so part of the reason I got it out, I'm going to flip to a monthly chart. This is the total trading history of this, this ETF, which is a clean energy ETF. If I do a Fibonacci retracement, so if I go to the all-time high, to the lowest low, last week's high, hit the 62% retracement on a monthly 13 on a stock that I'm long at 30 that's trading north of 90. So it tripled in price since we bought it in March. Could it go up past here? Absolutely. Am I going to take the risk right now to be the one holding it for that to happen with a monthly 13 in place, with a weekly 9 in place, with a daily 13 in place? And there were lots of 13s along the way, but when I have a daily that lines up with a weekly, that lines up with a monthly on a major Fibonacci retracement, I'll say, you know what, I'll let somebody else take the risk. I want to buy this on a pullback, but I was very content in having this trade 3 times the price of where we got in, which means we made 200% on our money and walk away. So again, another example of hitting targets and taking them. And the last one is something I did myself recently. I bought Slack simply on this 9 against a propulsion exhaustion level to the downside that was also against this red dotted TDST line. I bought it right here. Then, if you had no idea this would be a takeover candidate, and I sold some at 36.75. I sold actually on either side of this. Nope, I take it back. I sold some right near 33. A sixth of my trade here, a sixth here. So I've sold a third out, and I still have more on. And maybe this gets up to 49. I can trail my stops, But when I hit targets, I take them because you never know. If this deal falls through and was it Salesforce doesn't end up buying Slack, this thing will come off, in a split second. So again, I'm reiterating a concept I've told you before, and obviously I have the tools to be able to identify targets, but this is why, in the reports we write, and I urge you, do your work. If it's helpful, and I think it would be, subscribe to the weekly tactical trader report so you have targets for the S&P and for gold and for the dollar, as well as any ETF we get you into. Then you'll have a much better chance of doing well over time in your trading accounts. And occasionally, like we did with PBW, and like we're doing now with MJ, sometimes our trades turn into longer term investments. And there's often a reason. Like, I do think, pot stocks are as bad as they were going to get. And, this is something that we can hold for a while. I don't think we're going to revisit, the low levels we saw a month and 2 months ago. I do think clean energy, for a year and a half, I've been talking about clean energy as being the place you wanted to be. And, so I was willing and looked at those more as their trades, but their trades I might very well hold on to for a while. But other times, we take trades, we make 6%, we make 10%, we lose 5%, we get whatever it is, we get out, we stop ourselves out, or we take our profits and we move on. And that's the difference between trading and investing. But, I can't tell you more emphatically about taking partial profits, at least partial profits at your targets, and only stick with them if there's a real good reason other than, gee, I hope it goes higher, in order to stick with them. All right, let's go back now to our slide deck, and just as we always do, take a look at the week over week comparison in the S&P sectors. There's only two sectors this past week that gained on the S&P by more than 1%. That was communication services and technology. Tech is still up 22% on the year, but well down from over 30% versus the S&P. Energy actually had a lousy week. The last week it lost over 4%. From where it had been. So it's back down to almost minus 50% compared to the S&P. Also, industrials lost, utilities, and real estate. So you are seeing shifts going on towards some of these cyclical sectors where they have good weeks and bad weeks. And that's part of the cyclicality of what's going on now. And some of the shift that has taken big gains away from technology and consumer discretionary, and to some lesser degree communication services, and started seeing things show up, because some of these names were much worse off a couple months ago. Obviously, utilities were the best performer since August until I think a month ago, and then they didn't have a terribly good November compared to the rest of the market. Let's now take a look at our charts again. Let's go back to, first let's take a look at the Dow. All right, so here's the Dow on a monthly chart. We've broken out certainly from the downtrend line over the last month or so. We're still kind of stalling in here, but count-wise, I don't have anything in the Dow right here. Count-wise, we're only up to, on the fastest count I can do, we're only up to an 8 towards a 13. Standard sequential is only on a 5 towards a 13. So it would still suggest that there's more room to go. But look, there's clearly some selling in and around 30,000. We see it for a month in a row. You're going to need some good news or something to push this higher. Otherwise, you still have the possibility that it can come back and fill in the gap here. So it doesn't mean to me that I won't hold on to gainers, but I'm probably not chasing after high price stocks now. I'd much rather be buyers on pullbacks than chasing. And just 6 weeks ago, you had a pullback. You went right down to the weekly propulsion level. It held there and created this leg up. So the market does give you opportunities to get in. You have to be patient. But if this gap filled in, I'd say probably somewhere in the gap to down to wherever the conversion line is going to be, first kind of an important support there. Let's look at the dollar index, because the dollar is weak today and virtually on its worst levels of 2020. It has finally broken down from that uptrend line. This purple line goes all the way back to the lows in 2011. And this helps kind of up the odds that we're going to get down towards this prior TDST level at 89.23. And my target for 2021 is that we will see just about 87.5. So I'm still bearish on the dollar. Certainly snapbacks and short coverings can happen anytime. But I do think the heaviness that we've seen kind of starts, creating another leg down. So I would look to be sellers of the dollar on rallies. And let's then just take a look at crude oil. Here's a daily chart. So back here in April, this is when the front month went negative. But the front month at the time was not the active month. It was just, a day before expiration. So you're seeing a price that only got down to about, 650 in what was the active month at the time. So this is a rolling futures chart. We had some 13s up here as upside exhaustion. They worked decently well, sold off into a 9 bottom. This sold off into a 13 and 9 bottom, and here's a 13 bottom too. So this has been bullish since. And oil, kind of now, it had been hanging out near $40. Now it's hanging out near 45. And I still don't think fundamentally there's a lot of reason for oil to materially rally from here. But you've got OPEC meeting, and they delayed a meeting that we would have had the results today from until later in this week. So we've got to see kind of what OPEC comes up with. I'm still kind of waiting for a spike and a pullback. I'd love to see like a $3 up move, and for it to only close up $1 on the day, and then I kind of have a spike and something I feel like I could lean against and potentially upside exhaustion. Obviously, demand isn't high with COVID being what it is, so this is more of part of the effect of trading a market that is affected by a cartel to some degree. Of course, this is U.S. oil. It's not Brent, but OPEC and how much they're going to release into world supply definitely affects the demand for U.S.-based WTI oil. So that's my feeling for oil. Let's take a look at here. Let's switch this. We'll go put up a weekly chart of XLF. All right, so here, let me just put let's put a cloud on so we see what that says. All right, so financials, the last 4 weeks continue to rally. They gapped up in November. November obviously was a tremendously strong month. Last week qualified and confirmed the breakout. So this does say over time, we should expect to move up to 3182, the propulsion full exhaustion target that would be above all-time highs. More or less, you're going to have the same situation. There's a gap here. There's a downside propulsion level of 25.22. I hardly think that financials are going to materially break beneath that level. So anything, if in the future you get a chance to buy in the 25 handle, I would do that, because it should not get lower than roughly 25.25. So financials are looking better. This, of course, on an absolute basis. Let's look at, let me see, I'm trying to remember here we go. So we actually looked at Berkshire Hathaway a couple of weeks ago, because we did an episode on value names. Now we're doing pure financials. And it shows up as, the big cap name. So stocks trading at 230. You also just turn this into a qualified and confirmed breakout. Upside targets 245-ish, and then 261.5 off of this chart. We did just make all-time highs a couple of weeks ago, but still kind of hanging in here versus those December and January highs. If it pulls back, same type thing as XLF, anywhere from, I don't know, I'd say anywhere in the gap level, I'd certainly be willing to buy. And I don't even know if you fill the gap. I'd say something near 217 right now would be a great buying opportunity. JP Morgan is next up. We also looked at this recently. The only thing here is that you've got a weekly 9. We know 9 sometimes top the market. It did here back in December of last year. It did that back in February of 2018. So I don't want to be buying the stock right now at $121. Rather buy a pullback anywhere from 110 down to 107 would be, I think, a great place to get into JP Morgan. Bank of America, BAC. Not as strong a chart, not nearly close to the highs the way JP Morgan is. Kind of, let's see, this dotted line was the old TDST line that it broke down from. So I wouldn't give it much resistance here. Also got a qualified and confirmed breakout, longer term targets, 33.5 up to 34 and change. If you get a chance to buy this in the 26 handle, I'd probably do that, looking to buy on a pullback. Here's Citi, also, weaker chart, stalling, but is getting, you want to see it get through its cloud at 57.56. You get a couple of Friday closes through that, then you can target up near 71. The gap is lower here, so I would think I'd look to be a buyer between 50 and 48. Wells Fargo, one of the worst looking charts, but we finally got a weekly 13 here. It is bottomed. I don't love the name long term, but I do think it's playable on the long side now. It is certainly a deep value name at this point. I'm not sure we're going to see this get much above 37, but from the current price of 28, it's plenty of upside room. So I do think it's a viable buy. BlackRock, the best name we've looked at so far, except we have a 9 and 13 right now, and it's the first one of the whole year on the weekly chart with a 723 upside measured target. So I'm not touching this name here. If anything, this may be a candidate to take profits from and to get into one of the names that we talked about. I mean, I can't imagine too many people on the street would say, sell BlackRock to buy Wells Fargo, but I would say that's how the charts line up right now. Morgan Stanley, my old shop, is broken out to new all-time highs. Same thing, there's a gap in here, propulsion and cloud levels, so anything in the, I'd say 56 to 53 range is probably a good buy on a pullback. Upside target is now 73. SPGI, which is S&P Global, also has made new all-time highs, has stalled from there, and I actually wouldn't do much at all with this right now. I kind of, just looking at the way this is set up, not a name I have as much opinion in. Goldman Sachs, I do own this name, and that is not Goldman Sachs. Here's Goldman Sachs. I'm long this name around the 200 level. So we're hitting some targets here, anywhere from 232 even up to 245. Place to take some profits if you're looking. Notice this made highs back in 2018 and still has a longer term upside target, just about 280. American Express, I think it's probably the last one we're going to have time to do. So off of all-time highs. Interesting stalling the last month against what had been a prior bullish support level, and but still has propulsion buy signals and probably targets 127.5 and ultimately 138 or so. Same thing, if you can get a chance to buy it in the gap here, probably 108 to 105, good place to buy it. That is it for this week. I hope you enjoyed the show. I am Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.